because cash flow is truly the name of the game. While you're growing wealth, cash flow is one of the most important things. And because you have to generate enough cash flow on a regular basis so that you can lead the life you want to live. But then you also want to be building equity for the cash out at the end, and provide you with their index fund model is the ability to build that equity for the cash out at the end.
How do you find the will to fight back against the world that wants to keep you sedated, average, and stuck in place? Join us for the tools and strategies you need to create a life of abundance, discipline, and high achievement. This is the Tactical Empire with Jeff Smith.
Welcome to another episode of the Tactical Empire. I am joined by Sean Ryder today. What is up, Sean? How are you?
I'm good. I can't complain. I'm a week and a half away from beach vacation with the family. By the time this podcast drops, I'll be sitting on the beach chasing kids around. So is it really a vacation, or is it just parenting in a different town, Jeff?
Parenting in a different town, for sure. For sure.
Yes. Yeah. Especially the Airbnb allows dogs. So we'll have our dogs there, our kids. So it's really just living in someone else's house for 7 days, and there's a beach a block away. So no different. Maybe I'll eat a couple more bites of ice cream during the beach vacation. But how are you and your family?
We're doing fantastic, man. Fantastic. I think we're about ready to move on to Pigeon Forge. And so we're looking forward to relocating, seeing some different scenery, and celebrating some birthdays. So my mom and sister just flew in for a few days, visited us. They rented a cabin in the RV park that we're at. And so they stayed a few days, visited the kids and hung out, and then went back to Charlotte and flew home. So that was fun. That's the first time we've had visitors on the road. But yeah, we're ready to go north, I guess, for a little bit. We're going west first. But
I was gonna say, where's Pigeon Forge? I was already confused on where it was, and you really threw me for a loop on you're in North Carolina, so you're gonna be going west, right? Pigeon Forge, is that in Tennessee?
Yes.
Right. I don't claim to know everything in the world, so I will show my lack of geographic locations for major cities in the United States. But Jeff,
part of what we're doing, though, the kids get to choose what they want to do for their birthdays within reason. And so we've got a 10-year-old birthday that's 9-year-old turning 10, and we've got a 4-year-old turning 5 within 2 days of each other. And so they have shared birthdays. And ironically, it's the 9-year-old's birthday, then it's my sister's birthday, then it's the baby's birthday 3 days in a row. So we've got 3 birthdays in our family 3 days in a row in July. So, but they chose to go to Pigeon Forge of all places. Super weird, but that's where they wanted to go. So we are exercising their choice.
I love it. Talk about choices, man. I've been on this podcast for 9 months now, and I think my segues to the topics are getting better. Talk about choices, Jeff. Everyone has a choice on where to put their money. And so here we go to today's topic. If you are an avid listener of the Tactical Empire podcast, you know that Jeff and I, we really aren't investing in the stock market. We don't have government qualified accounts that we're putting money into. And on a recent podcast episode, I forget the exact topic. Actually, I do remember what it was. It was our course on real estate property in the next 90 days. And we talked about the value of investing in hard assets. And the benefits of investing in hard assets. And I was listening back to that episode, and you said something, the phrase was along the lines of investing in the stock market is the lazy man's path to wealth. And it made me laugh because as someone who coached people and does coach people on things to do with their money. Now I solely do that through the Tactical Empire, but I was associated with another company in the past where I had to be a little bit more open to people who wanted their money in the stock market. And so the people who wanted their money in the stock market, there's like, how can I educate myself? And I was like, look, like if you're just trying to invest and hold long term, like just read the book, The Simple Path to Wealth. So your phrase, the lazy man's path to wealth, made me think of the book, The Simple Path to Wealth. So I will give kudos to J.L. Collins. I think he did a simple to understand book. And if you are someone that wants to be in the stock market long term, or you have no clue what you're doing, and that's just what you think you want and need to do, and you don't want to learn from us, and you don't want to do what we're doing, The Simple Path to Wealth, in 2 sentences: take your money, open a Vanguard account, put it in the S&P 500 index or a retirement date target fund, and just let your money ride for the rest of your life. Okay, cool. Now that we summarize that book in 2 sentences, go deeper on your statement about the stock market being the lazy man's path to wealth. And then the follow-up question is, does it truly make people wealthy? I think that's going to be the focus to today. How do we define wealth? What is wealth? And does the stock market actually get you there the way that we're taught and you think it's going to get you there? Jeff, run with it.
The thing I don't like about it is the risk. I've watched people work their entire lives and roll the dice on like their retirement age. Like they want to retire at 60 or they want to retire at 62. And if we're in a down market, like the stock market's roaring right now, but it wasn't a few years ago. You're gambling with your timing, because the last thing I would ever want is to say, okay, I'm going to put my assets in here, and then we're in a down market when you turn 65 and you're like, well, I'll just keep on going to work for 3 more years and see if we can ride it out till there's an upturn. Even when there's an upturn, you don't pull your money, the whole amount of it, and like you can start shifting it into protected funds that are a little safer, if you will. But for me, I think it's too risky. And when I say the lazy man's path to wealth, what I mean by that is you are again abdicating responsibility for your financial education and the moves that you're making, because you are giving somebody else your money and you're hoping that they give you that historical 8% rate of return that the market touts to return, right? But what it tells me is that somebody, a financial advisor or something like that, is taking your money and they are investing it on their own, and they are making more than 8% with your money, and they are kicking you back that 8% because you're paying them for the use of for them to invest for you, excuse me, but they're also getting access to your money, which is why you can't access it. And so they're making, I don't know, I don't want to speculate, but somewhere between, I would guess 12, 15, 20% on your money, and they're giving you 8% of that. So you're just filling up their coffers and allowing them to take risks and invest in things that are more lucrative so that you get this perceived guaranteed rate of return of 8% over a historical period of time. And there's also, and that doesn't even speak to the levers that can be pulled out from under you, because the guys that are in the know in Wall Street know when shit's happening. And so then they move their money, and you are the one getting left holding the bag when the rug gets pulled on the stock market. There's nothing that I really like about it, but I mean, I would rather invest in something safe and solid. I mean, at this point, 5 or 6% rate of return on savings accounts online or money market accounts are better uses of money, in my opinion, than the stock market. Because at some point, a bubble's going to burst, right?
Yeah.
Go ahead. If you're lazy about it and you're not going to do anything anyway proactively, you're going to reap both sides of the risk reward cycle. Meaning, like, if it is actually an inflated bubble and you're watching the market rise right now and you're happy and you're justifying it, but you're not doing anything, you're going to be dealing with the L's on the other side of that at some point. Because when the bubble bursts, you haven't made any changes anyway. So you're like, well, we'll just ride the downturn and then wait for it to come back. And that's the cycle too many people get involved in.
Yeah. I think I agree with everything that you're saying. And the way that I kind of, when people come to me and ask my opinion on it, it's like, look, when we were younger, we were taught that we need to save, right? You need to save, you need to set money aside, you need to put it in this account, You need to put it in the stock market and not think about it till you're 65. And something didn't, I just couldn't ask the right follow-up questions. But I'll tell you right now, Jeff, like something didn't sit right with me when someone is telling my money be 50, 20, 25, and I can't touch it till I'm 65, or I shouldn't think about touching it till I'm 65. I can articulate myself a lot better nowadays. I don't want to be wealthy when I'm 65. Let me rephrase that. I want to be wealthy when I'm 65. I don't only want to be wealthy when I'm 65. Right. So that was like step number one, was me just acknowledging I want to be wealthy today, not only when I'm older. But when you actually talk to people about why you want to invest when you're older, or like how the math works, they're like, look, when you're 65, you're probably going to have a paid off house. You're probably not going to be spending money on your kids. You're probably going to be spending less money in general. And like, I'm in my mid 30s now, and it's like, I don't want to like downgrade my life. I don't want to be spending less money when I'm older. Like, I want to be riding the wave and like on a freaking magical unicorn pissing rainbows when I'm in my 65. For the last 50 years of my life, I plan on living to be 100 plus, as long as I can move my fucking legs. And so that was like the first thing, is getting past this either or mentality. Well, you need to save or you're going to be mad when you're 65. Like, you need to sacrifice a little now or you won't be wealthy when you're 65. No, there are investment vehicles that have the same, if not arguably better, long-term appreciation benefits when you factor in everything, not just a ROI percentage. Because I hate how people compare investments only based on a typical rate of return. Like, there are so many other benefits to the long-term appreciation. Number one, so I will get the appreciation, but they also benefit me today, a la putting cash flow in my pocket. And that's what I had to educate myself on. And I do want to, that's my first thought. And then I want to go back to something you said about if you're giving your money to someone, they have to be getting a better return in order to just pay you a return. And I listened to a podcast, and I don't think I've ever stated on ours, but because he's kind of changed he's kind of changed the theme / topic of his podcast, but Joshua Sheets of the Radical Personal Finance podcast. You go back and listen to some of his older episodes. He's focused a lot on money. Now he's kind of shifting to like homeschooling and preparing to be able to live in other countries and stuff like that. He still talks about money, but one thing he said was taking your money and investing in index funds. He said, why would I not invest in index funds myself and just give my money to a financial advisor to do the same thing? And he said, because the only question you need to ask a financial advisor is, what is your delta between the return you can get me and what the market can get me by itself? His argument was, if you can invest in an index fund and get 8% averages, the only reason why you would give your money to a financial advisor is because they can historically, year after year after year, tell you that they can get you 12%, and then they remove their fees and you're still winning above the 8%.
Yep.
Because if they're just getting what the market gets, you're losing because they're going to take their percentage off the top. And so like that really hammered it home, was like, I don't need that much education to be as good or better than the people who have a couple letters behind their name, and they have a little office in the downtown Creekside retail shopping center, and all they do is peddle people to come in and put their money in the same index funds that everyone has access to through Vanguard or whatever company you want to use. And so like, once I realized that, it was like, this is a losing game. Not only potentially long-term, because you're absolutely right, Jeff. If I plan on retiring at 64 and we are in the shitstorm of an economic downturn the year before I turn 64, I'm not going to retire at 64. So now I'm completely out of control of this plan I had for the past 30 years.
Yep.
Not good. Now, every dollar I set aside that I cannot touch, or I will be taxed or penalized or whatever regulations are against it, is a dollar that does not benefit me and my family today. And arguably, it is more important in today, July of 2024. It is arguably more important that I need money today with what inflation has been for the past 4 years. So I'm not telling people not to invest, but I need to take care of my things right now because things are hard for a lot of people. So yep. I'm not saying keep your money in a bank account so you can afford your groceries. We're saying you need to put, number one, you need to try and increase your income anyway, anyhow, whatever that means to you, increase your income. Maintain your expenses to create a good delta between the money that comes in and the money that goes out. The difference there, you cannot sit or hide that money away. You have to protect that money, ideally in high early cash value life insurance, and then you need to leverage those policies to acquire real assets, hard assets, the cash flow that put money in your pocket today. You will get the long-term appreciation, but we need you to get money in your pocket today. And outside of the stock market, inflation, it should piss you off because everything is more expensive today. But what people don't talk enough about, Jeff, is every dollar that you have to put towards the same lifestyle to live this year that you did last year, every dollar that you have to put towards those things is a dollar you can't invest. So not only are you getting screwed on having to pay more to live the same life, you now are losing this huge opportunity cost because that's a dollar that can no longer ever grow for you for the rest of your life. And so maybe I'm getting a little strong, long-winded, number one. Two, very strong in my voice because we haven't talked about a topic like this that I'm extremely passionate about that I want to hammer in people's heads. Inflation is destroying your ability to invest. Investing in the stock market destroys your ability to live a better life now. And you should not be thinking about either or. I need to sacrifice today to grow long-term, or I need to sacrifice my long-term investing to be able to afford groceries today. You can implement a strategy that allows you to succeed at both. And I think that's why I support Jeff's statement that the stock market is the lazy man's path to wealth. Because I don't think it's making your life wealthy today. And I don't think it's going to make your life as wealthy as you think it will in the future.
There's people that dominate the stock market and do very well and spend a lot of time in it that are, are just regular Joes, not like Wall Street barons. Like, that's not what I'm talking about. But like, ultimately my perception and thought about the stock market in general is it really is just a place for the middle class to send their money so that the wealthy can use that money to make more money. And the faster you understand that, and it's because of the abdication of responsibility that you're talking about, because cash flow is truly the name of the game. While you're growing wealth, cash flow is one of the most important things. And because you have to generate enough cash flow on a regular basis so that you can lead the life you want to live. But then you also want to be building equity for the cash out at the end. And what they provide you with their index fund model is the ability to build that equity for the cash out at the end, but it's minuscule by comparison to what you could do. And there's no cash flow associated with it. And so that's why they hammer just really simple terms like compounding interest. And that's all you're looking for. If you give us $21,000 a year in your 401k, we'll give you $4.2 million when you turn 62 and a half years old. That's abysmal when you think about the ability to take $20,000 a year. That buy you a single family home for the last 40 years. That would buy you at least one single family home a year. And that $21,000 that you put in your 401k. And if you do that for 40 years, you'll be far better off than the $4.2 million pot of money you have sitting in your index funds when you're 62 and a half years old. There's just so many reasons I don't like it. And that's why I prefer life insurance, because the thing nobody even mentions about life insurance is you have access to your cash all the time, and it earns 6.5%, 6.5% every year forever. There's no volatility. So if you want to do the same tables to 65 years old when you want to retire, an actual number because it's going to be 6.5%. There's no volatility of ups and downs. And nobody ever talks about the fact that you're buying a death benefit for your family. So you're leaving your family better off. I mean, we harp on the cash, the liquidity availability, and the fact that it grows uninterrupted. We talk about that stuff, but like elephant in the room is that I also bought $20 million worth of death benefit for my family. And so like, they're going to be fucking happy about that. Someone's going to benefit from that.
That's actually the silver bullet that I use in the discussion I have with people that love the stock market. They're like, but I can get this return, but I can leverage my account. And at the end of the day, the argument ends when I say, if you want to leave a legacy, I can get good returns, grow my money, acquire assets. And at the end of the day, when I die, because that is a fact, I will die. Yep. When I die, not only will my assets be given to my children that I use when I leverage these policies, the death benefit I bought is going to be a multiple of the number that I put into. So not only am I getting my money back in the cash value growth, and I'm going to surpass that, no doubt, as long as I live more than 10 years past my policy effective date, the death benefit is ginormous. It grows every year the way that these are structured. Last year, when I put $25,000 into one policy, and I've had it for 4 years. So when I moved $25,000 from a bank account into cash value life insurance, $25,000 showed up in cash value and $25,000 showed up in death benefit. Because then you're going to hear people say, what happens to your cash value when you die? Oh, you don't get both? I'm like, my death benefit is growing more than the money I put in. So I'm using the money I put in to acquire real assets. I never liquidated. And at the end of the day, hopefully I live to be 100. That one policy of the 6 I own will be $14 million of death benefit when I am 95 years old. When I opened it, it was below $1 million. And so not only are they going to get the assets, they're going to get the death benefit. And so that is the silver bullet. It is the life insurance. Again, this episode is not about that. It is the best product at the end of the day. It is the best product at the end of the day. So I had something else I wanted to say, but you brought up the elephant in the room that no one actually wants to talk about, which is the most boring part of life insurance. When you're talking about life insurance, is the death benefit, but it ends the discussion.
Like in the tables that I quoted, 62 years old, they'd have $4.2 million in their 401k. What you have to understand is that you're going to start drawing down on that to live off of it. That's and right. then you're going to deal with the volatility of the future stock market for the next, from 62 to 92, you've got 30 years of the stock market fluctuating again, and you're drawing down on that nest egg of 4.2 million. I didn't mean to turn it into infinite banking, but here we are.
No, we'll circle back, because people say, again, we're not going to dive down into breaking down numbers for people. Like I actually don't think you need to be a math wizard. You do a little bit of research. You do a little bit of research and realize that the 4% rule it's not realistic. It's not helping anyone. And the 4% rule is like, you have $1 million and you're going to live on 4% in perpetuity. But when you factor in the volatility, like, you're going to run out of money. You're going to run out of money if you're half healthy and live past expectancy on your life expectancy. You're going to run out of money. And so I don't want to play that game. And without diving into the specific numbers, like, I do want to be transparent with people. My wife has a 401k. I've said this on other episodes. It did not look too pretty the past 2 years. Let's say hypothetically that, a year ago it was at $130,000. Well, I just so happened to log into it this weekend to kind of see what the balance was, because the stock market's at an all-time high, Jeff. So I was like, oh, it should be pretty well up there. If I keep the ratios the same on what her real numbers were, the 130 is now worth 240. It's gone up quite a bit in the past 12 to 18 months. So am I happy about that? I'm grateful. I'm grateful that she has a really nice account balance on her 401k.
Yep.
That does absolutely nothing for our family when we walk into the grocery store today. It does not help us pay our mortgage. It does not help us take our vacation next week. All it's doing is bumping up our net worth. Is there value there? Yes. Can we leverage her 401k? Yes, up to the government imposed limit of $50,000, because she has more than 100 in there. And so you can only loan against 50% or a maximum of 50 grand on a 401k. So we could leverage it. We haven't done that yet because we don't need to. But if we wanted to liquidate it, we would be paying 33% in taxes plus a 10% penalty. So there goes 5% of the money that she set aside because she's not 59 and a half. That is asinine. It is absurd. And I want people to realize that that is not only arguably not going to help you in the future, it's definitely 100% pretty much a fact that it's not helping you today. And that's what I want to hammer into your heads today, that you can chart a different course. You can move your money. We're not going to tell you to liquidate those accounts, but we are open enough to tell you that we did. I liquidated a state it wasn't a pension, but a state investment account when I was a teacher. I liquidated that after 5 years of investing in it. It wasn't a ton of money. I paid my tax, I paid my penalty, and I started my new strategy. And that money has been used to buy real estate.
Yep.
And real estate puts money in my pocket.
That's accurate. That is accurate. I don't know. You nailed it, man. You hit all the points. I don't know. I wish people would take more responsibility for their financial education. And that's why I actually took the time to sit down and put together the 7 levels of financial freedom, because like I didn't feel like I just told you guys this for 5 years. I never put a structure to it of how to work through the cycles.
Yeah.
And so for me, that really codified it in my mind of how to like step by step go through the flywheel effect and keep expanding on what you're doing. But I mean, financial education is your path to charting, taking control of your life and your future. And it really just allows you to hold on to more of your money, generate cash flow now that gives you options and choices. Like we talk about lifestyle creep and stuff like that. If you get to the point where you want to allow your lifestyle to creep, then that's great. But like you should have the choices, and that's really what I'm passionate about. I know you're passionate about now index funds you can cash out. We use different terms here. If you have index funds and mutual funds and things like that, you can cash those out and pull them out. They're not 401ks. We talked about 401ks and mutual funds on this episode. Now, they're not providing cash flow though at the end of the day, and it's arguable on what you would prefer to be invested in this tumultuous economy that we're going into. I mean, we've talked about the devaluation of the dollar. We've talked about a lot of things. I can guarantee you that if the dollar switches its power in the world, which it already is, that it's going to affect the stock market and the paper money side of things, meaning like note investing and stuff like that, as far as being on the stock market. For me, I would much rather have real assets, hard assets. Even if you consider an index fund or mutual fund a hard asset, that's a topic for another day. There's just a lot of things that move a lot slower. And that's why I prefer real estate and other things. I mean, some people prefer minerals and gold and all this other shit, which is fine because you can also see that stuff changing at a slower rate too. I think those things just give you more time. That's what makes me so nervous about crypto and stuff like that, even though I've dabbled in Bitcoin and those other things, is that like with the flip of a switch on a keyboard, they can zero you out at any point in time, which is like, I mean, they can do that in the stock market as well. We've seen it, but like it's just that kind of volatility is not what I'm interested in really. Whereas like a housing crash or something like that, you can kind of read the tea leaves over a period of time and see it coming to an extent.
When I got into infinite banking and high early cash value life insurance, one of the agents I worked with sent me a really short, I don't even know if you could call it an essay, but it was like a 1-page essay called The Utility of Guarantees. And it is basically what you just said. Like, I don't want to dabble in anything that fluctuates up and down. If something can give me a guaranteed rate of return, I don't even want to argue whether it's lower or higher than another asset class. Yep. Because the utility to never have to think about it going down because it's guaranteed allows me to go to new heights in other areas of my life.
Sure.
And so we're going to end it there. I think I've said everything I wanted to say about the lazy man's path to wealth, and arguably whether it makes you wealthy or not. I think there's obviously a better path to being wealthy today, in the short term, in the medium term, and in the long term. And we've packaged that together in a really nice 7 levels of financial freedom. A couple episodes back, you'll see a 7-part series on those 7 levels that you can listen to for free if you're not going to work with us. If you want to go deeper in how they affect and can be implemented in your personal life, you can work with us one-on-one in the Tactical Empire's inner circle. Jeff, send the people out.
If you haven't followed us on YouTube, go out and like and subscribe our page. It's the Tactical Empire Podcast. And join us in our free Facebook group, the Tactical Empire. Sean and I are here to help you. Shoot us a DM if you have any questions about any of this stuff, or you want to chat it up, or if you think we're wrong about the stock market, send me a message. We can talk. All right. Thanks, guys. Have a great week. Kick ass.